In this Patreon requested video, we're going to take a look at and compare the best high-yielding mortgage REITs that exist. This is a sector that I typically don't invest a lot of money into because a lot of these companies don't exactly have impressive track records. However, 3 companies stand out in my opinion as being among the best available in this category of high-yielding investments. These companies have proven themselves to provide either the best long-term growth or the best total return over the past few years. The top 3 mortgage REITs we'll be comparing today are Starwood Property Trust, Arbor Realty, and Rhythm Capital. All of these companies have their own unique focus despite all of them being MREITs, so I'll quickly go over what those differences are. The first company is Starwood Property Trust. This company specializes in commercial lending across many different sectors. Unlike many other MREITs that provide lending services, this company is not heavily exposed to office properties. Increasingly, Starwood Property is becoming more of a pure hybrid REIT rather than just an MREIT. A hybrid REIT is a real estate investment trust that holds both mortgages and physical properties in their portfolio, so it's really just a blend of both an equity REIT and a mortgage REIT. 2 weeks ago, this company bought a large portfolio of 467 properties from Brookfield for $2.2 billion, which was a huge surprise. So going forward, physical properties are apparently going to make up a larger percentage of their overall portfolio. Rhythm Capital is another mortgage REIT that holds typical MREIT investments like residential mortgage loans. But this company's bread and butter are mortgage servicing rights. MSRs are agreements that are set up by a mortgage lender to have a third-party company basically manage the mortgage on their behalf. The third-party company, which is Rhythm in this example, is responsible for collecting the payments from the borrower and performing other administrative services. For instance, a bank will issue out a mortgage to an individual and then give Rhythm Capital the responsibility of collecting payments and forwarding them on to the bank. And in exchange, the bank pays Rhythm Capital a certain amount for servicing the mortgage. This MREIT also owns single-family rental properties, an appraisal company, and a property management business. These are businesses that most MREITs typically don't go into, and it makes Rhythm Capital a pretty unique company to their peers like Annaly Capital or AG&C. Arbor Realty is also similar to other MREITs, but they have a unique spin on their lending business. This company mainly specializes in offering bridge loans for the multifamily sector. They do offer other kinds of lending services, but it's bridge loans that make up the vast majority of their portfolio. Someone will take out a bridge loan if they want to buy a piece of real estate, but they haven't yet arranged long-term financing yet. This is pretty common when it comes to buying real estate, like multifamily properties and offices, among other types. They also provide loans for buying single-family homes, but not nearly as much. So that's a brief overview of the 3 companies we're going to look at. Let's look at some quick metrics. As of the making of this video, Arbor yields the most at 9.93%, followed by Starwood at 9.63%, and Rhythm Capital at 8.2%. Arbor is the oldest MREIT, having been founded in 1993, but they didn't become public until 2004. Starwood Property Trust was founded during the financial crisis, and Rhythm is the newest company. Before revamping their entire business, they were previously known as New Residential, but I'll go into more detail on this later. Starwood is the biggest company when looking at market cap, followed by Rhythm and then Arbor Realty trailing them by quite a bit. All 3 companies pay quarterly dividends, so no monthly payers here unfortunately. Starwood is the only company that's externally managed. It's considered more ideal for a mortgage REIT to be internally managed because many externally managed companies pay their board members based upon the size of the company and not based on their performance. Internally managed companies pay their board members based upon company and share price performance, so you can see why internally managed companies are more ideal, but there are still some good companies that are externally managed, although that is mostly the case with business development companies and not mortgage REITs. Speaking of management, let's start by looking at each company's insider ownership. This is the percentage of all outstanding shares of a company that are owned by the company's board and their insiders. This information is being pulled from FinViz, and we'll also look at insider trades from secform4.com. Looking at Arbor Realty, insiders own roughly 4.1% of all outstanding shares. 2 months ago, this company's CEO made headlines by investing $2 million of his own money into buying more shares of his company. We can also see that no insiders have sold any shares of ABR since 2021. With Rhythm Capital, insiders currently own just 0.59% of all outstanding shares. Insider trading has also been pretty flat over the past 5 years, with only 2 trades taking place, both buys. Starwood Property Trust has the highest insider ownership percentage at 6.09%. But at the same time, they've also had a lot of company insiders selling shares over the past 5 years. But still, even after all of these sell orders, they have the highest insider ownership percentage, indicating that they're pretty confident about their business. Let's move on to dividend performance over the past 5 years. We'll look at dividend consistency, any growth, as well as dividend coverage. Rhythm Capital, like I mentioned in the beginning, went through a dramatic transformation following the COVID pandemic. The purpose of this transformation was ultimately because, according to management, they wanted to weather all economic conditions. This involved switching to internal management from external management, acquiring some of those additional real estate companies as mentioned earlier, changing their name, and honing in on more MSR investments. The 5-year dividend history doesn't exactly point an accurate picture, as again, they were changing their company. So let's extend it to 10 years. We can see following their transformation, they have been very steady with their distributions. They're one of only 2 REITs that haven't cut their dividends in our high interest rate environment. As of their most recent quarter, their dividend payout was just 48%, the lowest in the sector, and doesn't indicate any kind of trouble. With a dividend so well covered, why hasn't there been any growth, you might wonder, and I'll go into my theory as to why that is later. With Starwood, their dividend has been very steady. They've never gone through a dividend cut in their entire history, but they haven't grown their dividend in over a decade. According to their most recent quarterly results, their dividend payout ratio was 106%, which requires an explanation. Although their earnings currently don't cover their dividend, their CEO did give some insightful details. He claimed that, given their low leverage, they believe it, quote, provides us with the unique ability to ride out market disruptions, and we believe our dividend is solid. We have a very unusual portfolio. So they're claiming that their dividend is completely secure, so we'll have to see how that plays out if things don't improve. Arbor Realty has been going through their own struggles, as we can see they were forced to reduce their dividend 3 months ago. But note their ability to provide constant growth over time. Expanding their dividend history to 10 years, they grew their dividend a total of 23 times in the last decade, all because of their business strategy. In their last earnings call, Arbor CEO even said that they're planning to start growing their dividend again in 2026. But of course, that assumes that conditions are going to improve soon. Even after their latest dividend cut, Arbor Realty is still very risky. Their current payout ratio is 96.77%, which indicates that another bad quarter could result in a second dividend cut. However, pointing back to their CEO recently buying $2 million worth of ABR stock with his own money is giving people hope that the worst is over for them. Finally, let's compare total return. These companies vary a lot in terms of when they first went public, so we'll look at what their average yearly return has been since their IPO. Rhythm Capital's total return has been pretty good despite taking into account their new residential days. The average yearly return has been 10.45% since their IPO in 2013. Starwood is just slightly behind them at 10.43%, so it's been really close between these 2 companies. It also just highlights all the right moves that Rhythm has been making. Finally, looking at Arbor Realty, it's delivered an average annual return of just 6.05%, which has obviously been suffering a lot more given their recent dividend cut. So what can we take away from these results? Well, each company is in their own unique situation right now. Rhythm Capital currently has the best covered dividend as of the making of this video, but my growing concern is they might eventually transition away from being an REIT. Their CEO has emphasized on earnings calls that he wants Rhythm to become one of the biggest real estate companies in the world, which will not happen if they remain an REIT. My theory is that's why they've been avoiding increasing their dividend for so long. That's likely the biggest risk facing this company in my own opinion. Starwood is currently heading in a new direction by purchasing a lot more physical properties. We don't yet know what that'll look like in terms of their earnings, but it should hopefully result in someday more dividend growth since they can increase the rent on their properties. Their lack of dividend coverage is concerning, but they insist that everything is fine with their dividend, so a strong amount of faith in their management is going to be required if you want to hold this stock. Without a doubt, the best REIT when times are great is Arbor Realty. They have a strategy that delivers consistent dividend growth and superior returns, but during hard times like right now, they suffer more than the other 2. The dividend is still at risk right now, so we'll have to see if they can report better earnings next quarter. So Rhythm is currently the safest dividend, followed by Starwood Property Trust if that was believe in the board, and Arbor crushes both of them only when times are really good. But with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.